Okay, hey accounting class, Mr. Vashon here. This is going to be video 1D on the general ledger and the trial balance I'm going to introduce here as well. So the goals for this video, learning how to explain like what a ledger is, why we use it, how double entry bookkeeping works, and recording transactions to T accounts and confirming its accuracy with the trial balance. So most of this video is just going to be walking through an example and seeing how it works, and we'll move from there in class. Okay, so this video is just going to be a quick review of transactions, which won't be long, ledger and T accounts, and then we'll make a trial balance to confirm that our T accounts are done correctly. Okay, these are not terms you're expected to know yet. That's sort of the purpose of this video, to introduce them. So one big picture that's going to govern a lot of this intro to accounting course is this one. So far, we've just talked about some pretty basic things. We've been talking about some financial statements just in the form of a balance sheet. Okay, that's actually going to take place later in the accounting cycle. The accounting cycle all starts with analyzing business transactions. Then you journalize entries, which is chapter 6. We're not going to talk about that for a while. Today, what we're learning are steps 3 and 4. Once we've journalized entries, we're going to post them to something called the general ledger, and we're going to prepare a trial balance after that. Okay, so that's sort of where we're going to be moving from in today's video and in the upcoming practice lessons. All right, so what is a ledger? So the general ledger contains all of the accounts maintained used by a business. It's used to maintain an up-to-date record of financial position. Okay, so the idea is we're all starting in a place which is denoted by, let's say, an opening balance sheet, which we all understand now, how a balance sheet shows the assets, liabilities, and equity. And from that, you gain a sense of financial position. But then obviously that balance sheet is only good for sometimes just a moment in time because transactions start to happen. The business has financial events that change the value of accounts. Cash, for example, being an asset account, account payable being a liability account, capital being an equity account, just as some examples, right? So each item on the balance sheet becomes an account and is kept in the general ledger. That's how a ledger works. So this ledger is used to track each account and how it's continually changing. Now, what we're going to use at this part of the course is just T accounts to show how each account looks. Okay, so you're going to be seeing a lot of this for the next couple days. Imagine right now that the way a ledger looks to you, it looks a bit different in formal real life, but just imagine all these little accounts that look like T's. Each asset account looks like this. Each liability account has its own T, and each owner's equity account has its own T. Okay, so each balance is going to be recorded at the beginning. So remember how I said we have an opening balance sheet? At the beginning, let's say this is the cash account under assets. There's a beginning value of cash before transactions happen. So we're going to start by recording all those beginning values on the proper side. All right. And then from there, we're just going to record all the changes like we did with that transaction analysis sheet, except this time, instead of doing it on a big table, we're going to do it on T's. So each account, you will record how much it changes. So it's sort of like the equation analysis sheet, except it's a ledger now. Okay, and this is going to be a little bit more proper and normal. Now, what's going to be important today to this lesson, the newest thing here, isn't so much going to be these T's, because once you see this in action, you'll realize it makes perfect sense. We've already done this with transaction analysis. It's the same thing. But the big thing is making sure that when an asset increases, or when a liability increases or decreases, or owner's equity increases or decreases, we're putting it on the proper side of the T, either the left or the right. All right, so I'll come back to this one in just a second to show you how that works. But this is an introduction to something called double entry bookkeeping. So a couple of you have been asking, you've heard the terms debits and credits before in accounting. And I said, wait, we're going to get to it soon. Well, this is that time. So debit means the left side of a T account. Imagine any T account. Okay, it could be cash, or it could be mortgage payable. Okay, both of these are accounts. This obviously is a liability account. Whoops, not quite working. This liability account, and this is an asset account. Okay, so in both of these cases, the debit is always the left side, and the credit is always the right side. Okay, so in double entry bookkeeping, anytime you're looking at a particular T account, if we're debiting it, it goes on the left. If we're crediting it, it goes on the right. Okay, that doesn't matter what type of account it is. That's always true. But what does matter is that debits and credits affect different accounts in different ways. So let me go back a slide and just show you. Each type of account, assets, liabilities, and equity, has a normal balance. So take a look at all the asset accounts you can see. Okay, let's see here. We got cash, accounts receivable, land, building, equipment, truck. So these are all of our asset accounts. What do you notice about which side the opening balance goes on? Is it debit side or credit side? Okay, these are our liability accounts, and this is our owner's equity account. What do you notice about the liabilities? bank loan, accounts payable, mortgage payable, is it normally a debit balance or a credit balance? And what do you notice about equity? Is it a credit balance or a debit balance? Okay, so what you notice is that each account's normal balance depends on the type of account. If it's an asset account, it always begins on the debit side. Liabilities and owner's equity always begin on the credit side. Okay, you might be noticing this is because of the fundamental accounting equation. Today, we're going to take this and we're going to say that instead of just assets equals liabilities and equity, we're going to say that debits equal credits in every transaction. All right, and that'll make a little bit more sense coming up. Okay, so this is like all about the normal balances. Now, if an asset increases, we're going to debit it. If an asset decreases, we're going to change it on the credit side. And it's the opposite for liabilities and equity. Liabilities and equity, since their normal balances are credit, if they increase, we're going to increase the credit side, or we're going to record the transaction on the credit side. And if a liability account decreases, we're going to debit it. Same with owner's equity. If it decreases, we're going to debit it. Now, if this seems a little bit arbitrary right now and kind of like random, it's just a way to make the system work. And if you want to make some sense of it, what helps for me is just relating it back to the fundamental accounting equation, right? Assets equals liabilities and equity. Assets increase with debits, liabilities and equity increase with credits, and they both decrease with the opposite. So kind of right now could be a little bit strange sounding, and let's see it in practice and see how this works. So these are a couple transactions from the last video. So last video, a business buys a new sofa for the office for $900. It pays cash. Last video, what we would say is that here we would say cash would decrease by 900 because we spent 900 cash, and our furniture would increase by 900. So what we're going to do now with T accounts is we're going to go to the cash T account, which will have an opening balance, and we're going to go to the furniture T account, which would also have an opening debit balance because they're both assets. And we are going to record this transaction on the proper side, okay? So cash has decreased by $900. So if an asset decreases, do we debit it or credit it? The answer is we credit it. So we would put $900 over here, and we put a nice 1 to tell us it's transaction number 1. That way we can understand it later. And furniture has increased by 900 in this transaction. So we'd go to furniture, and we would debit it because furniture is also an asset. And when an asset increases, we debit it. Okay, so we would now double check this transaction. So in this transaction, do debits equal credits? The answer is yes. We debited one account, doesn't matter what account, but for $900, which is furniture, and we credited cash for $900. Okay, so this is double entry bookkeeping. We always will debit an account and credit an account, at least one of each, and check to make sure that they balance. Okay, so let's do one more example really quickly, then I'll show you the T accounts. Hopefully that'll make some sense. So business makes a service sale for $29, customers pays credit, slightly like a problem we did last time. Okay, so let's do this one a little bit more quickly. So we just got paid credit, or we're gonna get paid, we build credit, so someone owes us money. So we know that from last lesson, account receivable here has to increase by $29. And business makes a service sale. For now, we're just saying that this means the owner's equity will therefore increase by $29. Okay, so assets equals liabilities plus equity. We always check. This is from last lesson. So we know that assets, accounts receivable, went plus 29, and owner's equity went plus 29. So the left side and the right side are equal. But now we're going to learn a little bit more. And what we know is that we will go to the T accounts for the two accounts that are affected by transaction number 2, accounts receivable, and we'll say JS, owner's name, let's say capital. Okay, now capital is owner's equity, so it has a normal credit balance, and accounts receivable has a normal debit balance. So here we have accounts receivable going up by $29. So since it's an asset, we're going to debit it for $29. We'll say transaction number 2 next to it. And for capital, we know that capital also went up by $29. Remember, owner's equity also goes up by $29 here. So since capital is an owner's equity account, when it goes up, we credit it, 29. Okay, and the reason why is because when liabilities and owner's equity go up, we credit it. And when assets go up, we debit it. So this is how we would record that transaction. Double check, do debits equal credits? Yes, we debited one account in this transaction for $29, and we credited one account for $29. Double entry bookkeeping system holds up. Thank you for your patience, by the way, with this explanation. So the rest of it, I'll just be really quick and just kind of show you what this would look like in action. So imagine that you're given this balance sheet, So you're going to do a ledger. You're going to journalize some, not journalize, sorry, but post some transactions into a ledger for Pacific Trucking. So you were given an opening balance sheet, and then you were told that all these transactions happened. What would you do with T accounts? Well, you'll have a page that looks like this. So the first thing we're going to do is we're going to start recording the beginning balances. That's step number one. Okay, so record beginning balances. So basically, they have cash for 3265. So you would go to your T accounts, you'd pick a T under assets, and you'd say cash, and I think it was 3265. So which side do we put it on? What's the beginning balance? What's a normal balance for assets? It's debit. So you do 3265. And I won't do everything. I'll just do one more example. Let's pick something. So you would keep going down this list. You would then make a record for account receivable for this person, Caruso, account receivable for Van Loon, for supplies, for trucks, equipment. You'd fill all the asset T accounts. All of these would be on the debit side. Let's say we're doing a liability account. So let's say AP Dini Bros, because I like that name, for 1516. So then you would come over here and you would say, maybe that'd be around here, AP Dini, I think the number was 1516. So since it's a liability, the normal balance goes on the credit side. And then what you would start to do is go through the transactions and record them. Okay, so the transaction, let's just do one or two here. Transaction number one, the company purchases $200 worth of supplies from Pacman Products to be paid for later. Let's go actually with one that has Dini. Okay, let's go transaction number two, because these are the two I just posted. So the company pays $500 to Dini Bros in partial payment of the amount owed to them. Okay, so we owed 1516 to Dini Bros, and we've just paid $500 off of it. So what's going to change here? Well, our cash is going to go down by $500, right? Because we just paid $500 of our business's cash to start paying off the debt that we own to Dini Bros. So cash goes down by 500. So that means we're going to credit cash for 500, because when an asset decreases, we credit it. We're going to put number one next to it. You write way smaller in real life, obviously. And that's our credit. So what's our debit? Well, the other account that changed in this transaction is the account payable to Dini Bros. It was 1,516, but it's gone down by $500. So when a liability goes down, we debit it. So we paid off 500. So this will make that number go down a bit. We put number one next to it, and we're done. Okay, we just recorded a transaction over here. Okay, now do debits equal credits? Yes, because we credited one account cash for 500 and we debited another account payable for 500. Okay, so debits equal credits. So that's a good way to check to make sure you did the transaction correctly. Doesn't necessarily mean you did, but it's a good sign. So I won't go through all the other transactions. We're going to practice these in class, but that's basically how it works. Now, here's what the finished product will look like. This is the example from the textbook, by the way, if you want to check it out in chapter 4 for more detail. So as you can see that it looks very loaded right now, but basically all you have here are just a bunch of beginning balances. So cash's beginning balance was 3265. As you can see, account payable might have been for Dini Bros was 1516, like we recorded. You see the transactions we recorded here are also recorded. And by the time you get to the end, let's say you're done, you have all the transactions recorded, you put a line down below and you just make a total. So like look at supplies as an example. So after we're all done, we record all the transactions. They made this nice line right here, as you can see. And they just added them up. So they added up the debits. So supplies started at 2465. That was the beginning balance. And it got debited once over the course of the month or whatever for $200. So the new balance is 2665. All right, I hope that makes sense. Now, if you look at an account with transactions on both sides, both debits and credits, you still basically do the same thing. So Dini Bros over here started at 1516. This was our transaction. We debited it for 500, and then it also got credited later for this amount, 5,500. So same thing. We draw this line right here, and we just add up both sides. So the total debits to Dini Bros is 500 on the left. The total credits is 7,016. And the final balance of accounts payable after the opening balance, the debit it got, and the credit it got will be 6,516, right? Because the total credits were 7,016 if you add up the opening balance in transaction number 5, and the total debits were 500, so 7,016 right there minus 500, so many arrows, would equal the ending balance of 6,516. All right. So I hope that also makes some good sense. And please let me know if it doesn't. And if you want to talk about it more. So just to review the T accounts. So you have the opening balances you record the transactions, you do the totals like I just did. And the last thing I won't go into much detail on is just something we do as accountants to make sure that all these T accounts are good and in balance. These final balances at the bottom of each account that are circled, all we do is we take them and we copy them over to something called a trial balance. Okay, so this is for the same business. So as you can see, we just take the final balance of the accounts and we copy them down into either the debit column or credit column. So we just list all the accounts at the end. So for example, bank or cash had a closing balance of $215. Take the debits and minus the credits. So we're going to put down the trial balance bank for 215. Um, Bank loan, so a liability, had a final balance of $18,000. Okay, you can see here bank loan didn't change throughout the month, so it just stayed at 18,000. So we take it and we put it here. And the trial balance, we just add up all the debits, total debits, 89,049. Total credits, just take all the final accounts with credit balances, copy them down, and we confirm that it's the same. That's a trial balance. A trial balance isn't as formal as the other stuff, but I do have to end this video because it's getting a little bit long. Sorry about that. Trying to get a lot into this one so you don't have to watch another video. But I'm going to put some questions at the end for you to check it out. Here's a little bit of information on the trial balance. It's just to check the accuracy of the ledger, list all the final balances, make sure the debits equal credits. We'll practice this in class. And it's again just about checking that accuracy. So, in summary, this video was about basically explaining how a ledger works, also introducing the trial balance, and starting to learn how to record transactions. The big takeaway is sort of understanding this whole idea of debits and credits. Okay, assets get debited when they increase and credited when they decrease. Liabilities known as equity, the right side of the equation, is the opposite. They start as credits, and when they increase, they get credited. And when you decrease a liability or when you decrease equity, you debit it. Okay, thank you for watching the video, and let me know if you have any questions, and you can do these questions now. Thanks, everyone.